Shares of Chipotle are getting smashed today, down almost 15%. We're down even more at the open, and it has been a tough 2025 for the company known for its bowls and burritos, down 49% from the high over the past 12 months. I'm Jason Hall. This is Investing Unscripted. And investors right now have to be asking, is this the time to buy the dip on Chipotle, or should investors stay away? I'm going to take a closer look at the business, talk about why I think this could be a good opportunity to buy shares of Chipotle. I have two really good reasons why that I'll explain. But first, this video is sponsored by the Motley Fool. If you're looking for even more great stock ideas, we've got a great partnership with the Motley Fool who sponsors this video. We have a special link you can go to. It's fool.com/unscripted. That's our special link. If you go to that link, you can get access to the Motley Fool's 10 best stocks to buy right now. Plus, it helps us out. It helps us keep making these great videos with great investing content. Okay, let's get to it here. I'm going to share Chipotle's third quarter results right here. We're not going to spend any time in the presentation because it's a real straightforward thing that's going on. Revenue was up about 7.5%, about $3 billion, 0.3% increase. That's starting to tell us where the concern is. Operating margin fell a full percentage point from 16.9% to 15.9%. As a result, that 7.5% revenue growth only delivered 3.6% earnings per share growth, only a penny per share increase. And that's really getting into the nuts and bolts of why the market was so disappointed. Let's jump back to the second quarter results and we can kind of get to the bottom of what's going on. So a couple things, you're like, hey, this is a good trend. Revenue was up 3% versus that 7.5% increase in the third quarter. Comps were down 4% versus that little modest increase that we saw in Q3. Now, here's a couple things, again, to start getting to the core of it. Operating margin fell substantially. Earnings per share did grow, but again, they weren't the kind of growth that investors were looking for. We're going to slide down here to the outlook because this is really telling the story. The company said back after the second quarter results that it was expecting full year comps to be roughly flat. Now you go to the updated guidance. Now they're saying, we think we're going to see declines in comps in the low single-digit range. So yeah, sure, Q2 to Q3, comps came in better, less worse really, because again, that's still trailing inflation. New restaurant openings are driving all of the growth for the company right now. Margins are getting thinner. And now we're saying, you know what? We think this is going to continue for the rest of the year. The market is reacting to missing expectations and then lowering guidance. So here's the question. How should investors be processing this information and thinking about Chipotle as an investment going forward? I think that Chipotle is still my favorite in fast casual and casual restaurants, and why I think it's worth buying right now. So we're largely seeing in fast food restaurant and fast casual, the trends are pretty negative overall. Chipotle is not alone. That's really important because if all of its peers were doing great, then you've got a problem with a business. You have a business that needs to fix some things. This is a bigger trend for the restaurant industry writ large. There are some restaurants on the lower end that are doing pretty well. And then you look in the higher end of casual restaurants, those are actually having a moment right now where business is doing well. What that says is more about the state of the consumer right now. And the reality is when it comes to a business like Chipotle, I think a smart way to invest is to think counter-cyclically. When times are bad overall, and the business is still doing okay, and that's the state for Chipotle right now, the market tends to overreact and tends to beat down the stock. And we've certainly seen that, but it's still the cream of the crop when it comes to the quality of its business and the profitability that it's able to earn compared to some of its peers. I'm going to start with this. This is Chipotle's operating margin. Going back to the 2015 foodborne illness, where lots of people got sick in California. We had an outbreak in the Northeast. And then a few months after that, there was an outbreak in the Southeast that was tied to a sick employee. The stock plummeted. Business plummeted. We saw like a 15 or 20% drop in comps. It was brutal. People weren't going because they were afraid they were going to get sick. Management tried to respond. They stumbled and fumbled. And in 2018, the company hired Brian Niccol. Brian Niccol, of course, is gone. Brian Niccol has gone to Starbucks. But you can see over this period, of course, this is the pandemic, the company has continued to get more efficient and more effective at delivering value for its customers while actually becoming more and more profitable, higher and higher margins. Now, here's something that I also like about this period that I think is important. Scott Boatwright was the operations head of the company and was the right-hand man to Brian Niccol. Scott Boatwright had actually joined Chipotle before Brian Niccol. Scott Boatwright is the CEO now. is the one that took the reins when Brian Niccol left to go to Starbucks. So I have a tremendous amount of confidence operationally that Chipotle is in really, really good hands. So I've taken that same chart and we've still got that purple for Chipotle, and I've added some other casual restaurants to it. These are restaurants that are largely operated by the owners. Chipotle operates basically all of its restaurants in the US. Darden operates essentially all of its restaurants. BLMN Brands, that's Outback Steakhouse and some others, operates the majority of its restaurants, and then Texas Roadhouse. Now, I've got Starbucks on here. Now, Starbucks has a mixed model because it operates a tremendous amount of its restaurants, but about half of its restaurants are franchised. Worth having on here to talk about as well. So as you can see, it's the one that has consistently had some of the highest margins. And that's largely because, again, it's mostly coffee, super high margin product, but also that franchisee model that's a lot of its business. More recently, it's struggled as Brian Niccol's working really, really hard there to turn that business around. But again, that long-term trend for Chipotle is incredibly, incredibly strong. If we pull Starbucks off of here, so you can see it compared to those other casual sit-down restaurants that are largely operated by the companies themselves and not franchised, it has generally had some of the very best margins in that industry, and the trends are very, very favorable. That's worth knowing as an investor because right now we have an industry issue. We have macro issues. People are pulling back from their spending. They're being a little bit more frugal about when they're going out to eat. And that's affecting Chipotle, but it's affecting a lot of other restaurants as well. So that makes me a little bit less concerned about it. Take all of that and put it together. And I do think that right now, Chipotle is really compelling. We don't know how long the macro situation is going to take to play out. And that's important too, because, well, the market can make you look dumb in the short term. And I think investors that invest in Chipotle right now have to be prepared that we could see more tough quarters ahead. But I think if you look back in 5 years, 10 years from now, this is going to turn out to be one of those smart times to have acquired more shares of Chipotle. There's still a tremendous amount of room to continue growing, not just in the US, but around the world where they've just barely begun to dip their toes. I think Chipotle is a buy right now, but investors have got to be patient, get through the tough times for the industry before the quality of this business really starts to shine and investors recognize that and start to send the stock price back up.